Okay, welcome everybody. It's my pleasure to introduce this session on sort of firm-to-firm transaction data. My name's Dan Mawson. I'm a senior economist in the Department for Business and Trade, where my team, amongst other things, owns some of the microdata work in the department. I also, for my sins, am the chair of the Committee for Industry, Innovation and Entrepreneurship, which is the microdata hub of the OECD. And in fact, Christina is going to be presenting some of the work they've been doing in this space on this over the last few years. Before I introduce our panel, I thought I'd just sort of give my reflections on the topic. So I first came across the fact that firm-to-firm transaction data even existed in the 2010s. We ended up in this rather strange meeting, what was then, I think, Department for Business, Innovation and Skills, where we were invited in. And it turned out that the banks had all decided they needed to pool their transactions data. So they did the classic thing of creating a joint company who data warehoused all of it. And this company then said, well, we should probably figure out whether or not there's any other uses for this. So they'd gone to the Bank of England, and then they came to us. We sat there, and they presented what they thought they could do. And they said, well, do you think this will have any value to like government policymakers? We didn't so much say yes or shout yes as jump clean across the room and rip their arms clean off, because obviously immediately this was apparent that this was going to be incredibly valuable, not just in national statistical terms, but for business policy, consumer policy. There's a whole range of things this kind of data is amazing for. Obviously, that was pretty much kind of 10 years ago, and that's also the second point we have to remember is these new types of data, and this is very much the frontier of business microdata, take a long time to get going. What looks like a great and amazingly rich data set, there are always strange landmines. You have to understand, you need to understand how the data relates to other statistics. So it's really quite a long run, but quite important piece of work to actually understand how to effectively apply this to get policy-based evidence. So to discuss that today, we've got a great panel, starting with Christina Palmou, who is at the OECD, and she'll be talking about what's called the LIFT project. Then we've got Keith Lai from the ONS, and he'll be talking about the work they've been doing on transactions data. We've then got Rajssa Mechelli, who's at the CMA. And finally, online, we've got Verena Wiedemann from the International Finance Institute from the World Bank Group. And that'll be we'll be taking her questions in the hybrid form. So I'll now hand over to Christina.
Thank you. Make sure the clicker's working. Perfect. Well, good afternoon, everyone. Thank you for being here. I am Christina. I'm a researcher at the OECD, but I'm also a PhD candidate at ESCoE. In the next about 10 minutes, I will talk about firm-to-firm transactions data, which is a novel resource, a really rich data set that is becoming more widely available in some countries because of modernization of tax systems, in others because of greater cooperation with data providers and a sort of desire to leverage innovative sources to improve measurement. So in the next 10 minutes, I'm going to talk about this innovative, rich data set and how can we use it to improve measurement, develop further economic statistics, understand the world better, but also how is it important in moving forward research that addresses key policy questions, and more specifically in the area of productivity and firm dynamics. This is only an introduction, a scene setter. I'm extremely grateful to the tremendous expertise that we have today on the panel that will dive into each of these aspects in a bit more detail. So, where are we today, and sort of where are we coming from in terms of this data set? We hear a lot about economic security. It has become more and more a policy priority, both for the UK, but this is really a theme across many OECD countries. This is not a surprise. It has been a volatile few years. We've sort of gone through the pandemic, the energy crisis, conflict, a reconfiguration of trade relationships, and policymakers have really been confronted with the challenge of mitigating the economic fallout of the shocks that have often had far-reaching economic consequences beyond the firms that have been directly affected. But of course, with only aggregate information available of how do these shocks travel through supply chains, policymakers have often had a sort of blurry understanding, especially in real time, of which types of firms are most affected, which are the most effective mechanisms of adjustment. If we had information and leveraging information on the relationships between firms, making it part of the policymaker's toolkit, would allow for better understanding the supply chain risks, better understanding how these unexpected shocks propagate across the economy, but of course, better understanding also leads to better targeted, more effective policy. But don't get me wrong, this is not just about economic security and the fact that we're going through sort of a volatile few years. This data is important for long-standing questions around growth and productivity. So we know from the literature and research that has already happened using this data that firms influence each other through these buyer-supply relationships. For example, evidence from Belgium shows that when a firm starts supplying a superstar firm, whether domestic or international superstar, so this is not just about FDI, they experience sort of improvements both in terms of their productivity, but also in terms of their own buyers and suppliers and production networks. There's similar research from Italy on sort of technological diffusion. So if you think about growth and productivity, improvements in economic microdata in the last decade have allowed us already to go deeper into diagnosing the drivers of aggregate productivity trends. So we already know the aggregate productivity slowdown, for example, is underpinned in most OECD countries by sort of falling behind of the middle or low productivity firms, by a lack in private investment, particularly related to intangibles, a fall in dynamism and sort of a rise in markups, and whatever that heralds about potential concerns around competition. Adding to this analysis, as Dan said, the missing piece of how firms are connected with each other would allow us to break new ground in answering these long-standing growth questions and design more effectively growth and productivity policy. And making these interdependencies part of the policymakers' toolkit is now possible. In many OECD countries, like Belgium, Italy, Portugal, Spain, Greece, Poland, Estonia, Lithuania, Costa Rica, Chile, value-added tax systems are now becoming invoice level. So this data is being collected as a byproduct of modernization of tax systems. In other countries like France, this innovation is underway. In countries like the US or Japan, data is available for some firms through surveys. And of course, in UK and countries like Brazil, we have bank transactions, even though VAT systems are not really invoice level at the moment. And the UK is ahead of the curve in that sense. The ONS has already been doing quite a lot of work with this data. Keith will talk very much about that later. I just want to touch upon very quickly on the fact that this data is not just important in terms of the policy research questions that I mentioned, but it's also a big opportunity for economic statistics. The data tracks closely aggregate statistics like sort of GDP, production, the industrial composition of the economy. There's greater demand for real-time estimates of what's happening in the economy, and this data comes faster than national accounts. There's opportunities to understand better the regional distribution of economic activity, and Verena will talk a little bit more about that. We can use it to enrich how we understand and measure input-output relationships, and of course understand the structure of large firms and maybe the boundaries of the firm. And this is really kind of building on the momentum of a 10-year effort following the Bean Review to make more use of admin data, investigate deeper the economic microdata underpinning aggregate economic trends. Right, so in the next 5 minutes or so, I will use VAT data from 7 OECD countries to show you 3 stylized facts on OECD production networks. So how can we use this data even very early on in the analysis to understand the structure of these economies? The OECD project that these results come from is called LIFT, Leveraging Inter-Firm Transactions Data. This is not just my work, it's the work with co-authors both from the OECD and from each one of the countries that you will see represented in the results, without whose expertise and participation we couldn't have gotten here. And it is in collaboration with our partners at DG GROW and the European Commission, to whom we are very, very thankful for support and the collaboration. I should say these results are not in a published report yet, but a published flagship report will come out at the end of the year, so please keep an eye out. So, important statistic number 1, OECD economies are dominated by a few influential firms. In this graph, we plot the ratio of the buyers and suppliers of the 90th percentile firm to the median. So the 90th percentile firm here is the firm with more buyers than 90% of the firms in the network. The median is the one that has more buyers on half, less buyers on the other half. So on average, the most connected firms have 13 times the buyers and 8 times the suppliers of the median firm. So the 90th percentile firm has on average 40 buyers, 52 suppliers, the median only 6 and 8. This stark inequality between the most and least connected firms is pervasive across industries, so this is not an artifact of the industrial composition in the different countries, and it means that using only aggregated data, we're likely to miss key players, firms that are important choke points or supply chain bottlenecks. A second feature of OECD production networks is that even though there are a large number of new relationships being formed every year, it is durable relationships that carry most of the value. So here we plot the percentage of relationships in the economy that are carried over from year to year. So if we see a buyer-supplier relationship in 2020 and in 2021, this is a retained relationship. And you see that 54% of relationships a year are retained, meaning 46% are new. This is an incredible rate of relationship formation, of dynamism, suggesting that even in the absence of shocks, there's quite a lot of dynamism in these production networks. But actually, when we look at value, these relationships, these new relationships, don't appear to be a large share of the economy's total sales. So when you look at the share of value in retained compared to new relationships, 84% of value is in these durable buyer-supplier links. And this is important because it means that in times of crisis, rupture in a large number of relationships may not be as important for firm survival and resilience as stability of these important, critical supplier and buyer links. And it might also tell us something about the mechanism through which firms scale up, right? At what point the formation of these stable, valuable links distinguishes firms that scale up or sort of remain small. The third and final result I'm going to leave you with on production networks is that firms are very reliant on one buyer and supplier. We already showed that the median firm doesn't have many buyers and suppliers. Another way to capture this is to say that production networks are quite sparse. So in this chart, we plot each country's relationship density. This is the number of relationships that exist in the economy in relation to all possible links we could have if all firms were connected to each other. And you see that this is quite low. This is 0.01. This is only one relationship exists every 10,000 possible relationships. And density is an important structural statistic. It's positively correlated with GDP per capita because dense networks are better at propagating positive shocks. And on the flip side of that, research shows us that firms are likely to underinvest on average in well-diversified supply chains, and that when firms are hit with a shock, they sort of increase the number of buyers and suppliers they have afterwards, as if the shock made them aware of this vulnerability. So in dense networks, where the median firm is better connected, it's likely to have more outside options to weather the death of a given supplier. Not only do firms underinvest in hedging their supply chains in terms of its number of buyers and suppliers, but when evaluating how well spread out are sales and intermediate consumption over the different firms, we find that the average firm is quite reliant on one relationship. So for each firm here, in each of these networks, we calculate the share of sales and share of purchases from its most important buyer and supplier. So from the one that it sources the maximum amount of its intermediate consumption or sales. And you see that this reliance is quite high. So this is the average of this maximum for each one of these countries. And you see that the average firm sources 60% of its intermediate consumption from one supplier and relies on one buyer for 62% of its sales. This matters for resilience. What if the supplier dies? But it also matters for productivity. How do these important buyer or suppliers exercise their market power over reliant firms? And Rajssa will talk a bit about market power in supply chains. But also, how do they influence dependent buyers and suppliers? How do they influence their investment decisions, their production technology, their know-how? I hope I've convinced you that this data set is really powerful, really important, both for measurement and for policy. And I look forward to the discussion and the excellent contributions we're about to hear. Thank you.
Great. So we'll now move on to Keith.
Thank you. Hi. So I'm Keith. I am a senior economist at the ONS. And for the past 6 years or so, I've been leading work in ONS to develop financial transactions data, as well as other economic data sources like VAT data, and to try and develop them into like useful economic data for the rest of the UK and government, but as well for thinking about how they could be integrated into national statistics. So I think seeing Christina's sort of presentation on other countries' work, using VAT data, I think has made a lot of people, in UK very jealous because as Dan was saying that, in the UK it's quite rare, like to come across that sort of data sources. The VAT data in the UK doesn't have the same structure, doesn't have the same like transactional structure as in many other countries. So in ONS, we sort of accidentally stumbled into, what I would consider as the closest alternative to that in interbank payments sort of transfer data. So kind of like at the start of COVID, a firm called Vocalink sort of got in touch with ONS to say they're sitting on, a pile of data, pretty much like, what Dan was describing, but in a COVID like national emergency situation, and say like, can you do something with our payments data? And I imagine, like most of you here, you wouldn't have heard of Vocalink, but they're one of the most important companies in this country that you have never heard of. They practically run the interbank payment system. So every time you receive your salary, every time you receive your bill, or every time you make a transfer to someone, or any time like a business makes a transfer to another business, it will be somewhere on the system. So during COVID, it was about like, okay, they haven't really developed the data at all. So they were giving us like payment aggregates, and it was like, okay, it's kind of useful to track the macroeconomy. But as we work more with them, to understand the data, and then we start to begin to understand, they've got transactional data, because they actually sort of capture, every single banking transaction, from account A to account B, at what time, and there's kind of lots of other information on the system. And so we went on this sort of journey, partnering with them, with academics from Alan Turing Institute, and more recently with colleagues at CMA, to try to sort of develop sort of public sort of uses of those data. So I'm just going to be talking a little bit about that. So Vocalink and Pay.UK, as I said, they run the UK retail interbank payment system. And so that includes the faster payment system and the BACS direct credit, direct debit system. So between those two systems that they operate, that covers 99% of all the UK interbank payments, right? So super high coverage data set. The only bit that is not covered is in the Bank of England CHAPS payment system, which is super high value, instantaneous payment system that is typically used for buying a house or end of day clearing between the big banks. But yeah, 99% of other transactions in the economy sort of go through the BACS and FPS system. And just to give you some numbers, very big numbers that probably don't mean too much, but in 2025, the BACS and FPS system together they processed 11 trillion pounds. Okay, that's a super big number, and that covers 1.2 billion transactions, right? And the number of accounts on the system is 250 million accounts. So we're talking about like really big data sets, and obviously they have never really the company themselves, they've never really used the data for anything like research or economic statistics. They're there to make sure the payment system work, and that's it. But we realize the massive potential there. But the data is unstructured, and it needs a lot of work to give its like contextual meaning before it could be applied to the sort of work that Christina was talking about. Or more generally, just to compile our aggregate economic statistics. So, we've got a team of data scientists working very closely with Vocalink. So we're very lucky that, they have invested a lot in this partnership. But a lot of our data sort of science work is in around like, how do we make meaning out of that unstructured data? So things like, we see 250 million accounts, like I said, but what can we tell about the accounts belonging to an individuals or belonging to a business? Because that's a super important distinction. And if we identify an account belonging to business, what industry are they in and what region are they in? Well, needless to say, when if we identify an account belonging to individuals as well, we can do a lot of analysis around, consumer to business transactions or business to consumer transactions. But obviously, the focus here is B2B. So on the B2B side of the data development work, right, we've managed to identify of the 250 million accounts that I spoke about. So we do various, various ways of classifying the accounts by whether it's a business. For example, we look at the names, look at the account name. If it's got like limited or I don't know PLC or something like that, then that highly suggests it is a business. Conversely, if an account like says Mr. or Mrs., then more likely to be individual. And we also look at the network of payment, right? Who they pay. If they pay, business tax or whatever, then that suggests that it's a business. Or if they, get a pensions, and that's more likely to be individual. So there's a lot of, data science. At one point, we were trying machine learning as well. But yeah, a lot of techniques sort of go into sort of classifying the data. But the end result is we are able to classify about 3.4 million sort of organizations in the data. And that's a big chunk of what we understand to be the population of businesses in the UK, which is around 5.5 million. So we think we've got about 3.5 million organizations in our data. And obviously from there, we could have gone in different directions, right? We could have sort of looked at the sort of firm-to-firm level data, pretty much in the same way that Christina was describing, and then do quite a lot of research there. And I guess sort of we went in a different direction, which I don't think we've seen too many comparable examples around the world, which is we aggregate the data up to the industry and region level, and we try to make them publicly accessible. So we've published a number of publications to this day, and from tomorrow, I'm happy to announce that we will be providing a monthly sort of releases of that inter-industry and inter-regional payment flows data set. So if you're interested in that sort of work, so please take a look at that data. So why do we do that? Because we think it's it's timely. Because payment system data. If we wanted to, we could get data from tomorrow. From yesterday. Sorry, not tomorrow. From yesterday. So super timely. It's super granular. It's kind of obviously we have to group it to something, but at the heart of it is super granular, and it's very high coverage, as I said. Although there's some problems with the definite, things like payment flows, right? Typically in national accounts, for example, we want to, get to concepts like expenditure or, turnover or value added. Whereas we only see payments, but, often payments is a, good enough proxy for a lot of the concepts that we want to capture. And so in terms of, applications, why are we putting out this data set? We hope to, help, users out there, in the UK policy research space, to do, new analysis on supply chain, because you could literally now see the linkages between different industries and different regions in the UK in pretty much real time, and that speaks to some of the industrial strategy sort of work that we heard earlier today, some of the national work that we heard as well. There's a real angle towards real-time monitoring. Just as an example, last year in September, if you follow the news, you would have heard that Jaguar Land Rover had a cyber attack, and that sort of cost the economy 0.1% GDP is the estimate, and we have the data that if we had published the data back in time, by early October, mid-October, we would have seen in the data the extent, to which the economy and the supply chain was impacted. Because, if you go to the data, you'll be able to see that in West Midlands, in the car manufacturing industry, which is, where Jaguar Land Rover is based, you could see, a massive drop in payments from the industry, right? And outflow payments, you could imagine that sort of being sort of them buying stuff to produce cars. So we see 70, 80% sort of drop in that month, and that recover subsequently. And you could also sort of use the data to look at what has been a knock-on impact to other industries. So we know that car manufacturing industry interact a lot with the manufacturer of rubber and plastic and we see that in the data. We see that the payments to them have come down as well in that month. And then sort of more recently, there is the Middle East conflict. So in the bulletin tomorrow, published as part of the real-time indicators, you'll be able to see some analysis around the transport industry, and the payments to the fuel industry and how that has changed in March. There's a lot of real-time monitoring stuff that can be done with the data that then sort of hopefully speaks into that sort of GDP nowcasting, which was the topic of the last talk. There was call, from Raffaella for more granular data, more regional data, and we hope this data sort of plug that sort of gap. And obviously then, we've spoken to colleagues in DBT, Bank of England, Treasury, and CMA, and on the right. So we'll cover some of that work later on. So we see a lot of applications out there, eventually, I don't know if we'll ever get to a world where we could do sort of micro sort of firm level analysis. Hopefully, So this is just a summary of the developments that we have had in the UK in relation to firm sort of transaction data. I think we're just sort of barely scratching the surface of what is possible with that data. So I think sort of with more people using that data, giving us useful feedback on what they would like to see, but as well sort of a sort of, I don't know, wider conversation about, how do we sort of make sure these data are sort of sustainable? Can we build those? Can we build, there are talks about the next generation payment system in the UK, right? How can we build some of these lessons into the design of those systems? Would be fantastic. So, yeah, I think that's a wrap from me for now.
Okay, thanks, Keith. I'll now hand over to Rajssa.
Cool. Hi, everybody. Thanks for being here. I'm Rajssa Mechelli. I am from the Competition and Markets Authority. Specifically, I'm from the Microeconomics unit. That's a fairly small research unit in the CMA. So what we normally work on is policy-oriented reports. So we are literally users of the amazing data that Keith has been describing so far. I'm here today to kind of give you another example of how this data can be used. It will cover a little bit what Christina has just said and what Keith has said as well, but hopefully we'll give you a little bit of a view into how this data can be extremely helpful to inform policymakers, especially. So the main bit of what I will say is based on a report that's been published by the MU, by the microeconomic units a week ago, I think. It's a report on supply chains and market power that, as kind of the title suggests, tries to give some insights into the way the mapping and the way in which supply chains have evolved in the UK, and a little bit about how market power behaves along these supply chains. The reason why we started focusing on supply chains, apart from obviously being extremely important, as the CMA, you might be wondering why is that so important to you? Well, the first thing is first, as a research unit inside the CMA, we've been quite involved with kind of giving advice or evidence to the government in the kind of broad agenda of the growth mission. But secondly, if you think about the supply chains and the way in which market power can behave along the supply chain, obviously this can have some important consequences for consumers, and this is basically what the CMA cares about. So when we speak about supply chains, we normally have in mind some very complex network of interactions between firms. So these are very complex, dynamic, multi-layered interconnections that there's up there. However, when we want to analyze supply chain in a policy oriented way, in a way that can be helpful for policymakers, we are a little bit stuck with data availability. And normally what researchers can use is input-output tables that are great, but it's mostly what was out there so far. So this is why the business-to-business transaction data, and specifically the ones that we've used for this report here, are aggregated up to the industry, but they start from what Keith had just described. This is why they are so important for us. So the report builds on 2 data sources, and we try to also make sure to highlight what the difference in terms of results among these 2 data sources are. On the one hand, we use the more traditional ONS-provided input-output table, and on the other hand, the more experimental business-to-business data. Obviously, they both come with pros and cons. The IO table are formal, they are official, they are very structured, but they are also very aggregated. They normally don't go down more than SIC 2-digit level. And they come with a lag. It's normally quite a consistent lag. So they only allow policymakers to look at what happened a fair bit ago. The new experimental data, instead, they are very, very granular. What they made publicly available, and that is coming in an updated version tomorrow, is down to SIC 5 digits. So it's extremely granular. You have more than 700 industries there, and it's very frequent. It's a monthly basis, and is also much more timely. Obviously, it's a little bit more experimental, and I will say a little bit about that later. But the more we use it, the more we can understand the full power of of this data set. I obviously don't have time to just go through all the results of the report, so I've decided to just pick one result. Not because it's the first one in the report, I promise, but just because it's the one where I think it makes a lot of difference in terms of using the most standard IO table and the business-to-business transaction data. So in the first chapter of the report, what we do is just try to describe the UK supply chains and how they've evolved over time. And one of the metrics that we focus on is the supply chain length. So by that we mean the number of steps that there are from the initial input to the final consumer. This is obviously important because that gives us an idea of how complex and how complex is the supply chain. And what we find in the report is that on average, so this report it looks like the whole economy, and then it goes down to specific sectors, but on average, the supply chain length has increased quite a bit. Now, the direction of the change is coherent across the 2 data sources, so the IO tables and the business-to-business data. They give us the same change. So in both cases, we find an increase. However, when we look at the traditional data sources, like the IO tables, we find a fairly moderate increase, something around 5% in a period of time that goes from 2013 to 2022. When we look at the results with business-to-business transaction data, we find an increase that's so much bigger. It's 40%, and we are talking about a period of time that goes from 2017 to 2024. Now, we try to understand a little bit, or at least speculate about why there is this big difference. Obviously, here we think there are 2 things going on. The first one is the timing. The business-to-business transaction data, they cover a much more recent period of time, and therefore, potentially, there's kind of an end tail of a structural change that's going on in the in the UK with supply chains and production networks getting more complicated. And given that it's much more timely, we can see the full kind of range of that change. However, the level is also fairly different, and that makes us think that the real issue, not the real issue, but a big part of the change is driven by the fact that the data are so much more granular, and that when we look at the I/O tables, we are actually kind of merging away, we are like averaging away a lot of those nuances and a lot of those smaller interactions between firms that are potentially in the same aggregated sector. So think about two manufacturers in a kind of similar industry that would fall into the same 6-digit category, but not into the same, of course, 4-digit category. These two things could just be trading with each other to, exchange inputs for the production of a car, but those things would possibly be washed out when we look at the I/O tables. So it kind of is important to, to keep this in mind when we look at the results about supply chain, and keep in mind that this granularity gives us another source of looking at things in a very nuanced and very detailed way. Of course, in the report there's much more. Something that we point out is that obviously these data are extremely important to monitor and evaluating. They can be very helpful for the UK and other countries, of course, to have a way of checking things in real time or almost in real time, and just flag risks and fragilities very early on. This is not, of course, true only for specifically the supply chains. I think Keith was talking about industrial strategy. That's also another report that we've worked on, where we point out how policies in general in industrial strategy as well should kind of have some sort of monitoring and evaluation system built in. And of course, access to this data can be extremely helpful in monitoring and evaluating in a very timely way. Having an idea of what sort of spillovers a specific policy has on firms that are not directly targeted or industries that are not directly targeted would be extremely helpful for policymakers. So just to conclude, I think this data is just amazing. We are using it also in another report that's not been published. It's ongoing work. There, thanks to a collaboration with the ONS and their partners, so Vogeling and Pay.UK, we were able, we are still working on it, but we were able to build a firm level data set of supply chains and some proxies for outcomes that these firms have. So some proxies for turnover and payments that they receive from governments. And this is going to be used in a report that we are working on where we look at fast-growing firms in the UK, and that specific work will inform how these firms differ, if they differ, in terms of supply chain and supply networks. As I was saying at the beginning, of course, this data is still experimental. So the more we will use it, the more we will know about it. Some open questions for us that we've discussed with Keith, and we will go back to at some point, are around for example sectoral definitions. So how much do we know, and how much can we rely? I mean, defining sectors is always a little bit of an issue in data sets in general, not only even in survey and more administrative data, but how much do we trust these definitions in the data set, and is there a way to disentangle a little bit more the different types of payments that these firms do and receive, and specifically to very interesting things for us, but there might be so many others. We would love to see wages and have an idea of which ones of these payments are actually wages, so that it could give us a proxy, something that approximate the employer to employee kind of data sets. And also it would be just great to be able to disentangle other types of payments. For example, we see payments coming from the government, but we obviously don't know exactly yet, at least, which of these payments are like payments done in exchange for goods and services provided, or which of these payments are like, subsidies or grants or loans or these sort of things. So yeah, that's me.
Thank you. And finally, we go to Verena, who's online.
Thank you so much, Dan, for the introduction. Can you all hear me okay?
Yes, we can hear you.
Yeah, perfect. Amazing. Thanks so much to the organizers, especially Christina, for including me in this panel. And, this is great excitement for me. I'm really sorry I couldn't make it back to London today. Other commitments got in the way, but glad to be here virtually. I've been working on questions on how to strengthen domestic supply chains, how to think about domestic market integration and resilience since my PhD days back in Oxford, and that was actually in the late 2010s, exactly the period that Dan was talking about when this kind of firm-to-firm transaction data have become increasingly available, and that's what I started out with. So I've been working with this kind of data since, and I'm now an economist in the private markets department of the World Bank. What we do in that department is we do research on private sector development, firm dynamics, thinking about innovation, firm financing, productivity, some of it in the form of peer-reviewed sort of academic articles, but also some policy reports that really try to bridge the gap between the academic conversation and the policy dialogue on these topics. And production networks and understanding them is one of our central themes. What I want to talk about today is to briefly motivate why production networks matter for us and for policy, share some concrete example from different countries and how granular firm-to-firm data can inform that policy, and then also talk about a similar effort to what Christina has described, where we also harmonize VAT data from up to like over 15 countries we have currently in the pipeline that we've been building over the past year. The starting point is really simple on why production network matters. It's really like firms don't grow and become resilient in isolation. They're connected to suppliers, buyers, service providers, intermediaries, and have become the backbone of modern economies. And as a result, they matter when we think about policies to enhance productivity, but they also determine on how effective policies that we implement are. And to give an example, governments spend a lot of resources and effort to attract, for example, FDI. And the example that Christina gave, this really nice paper for Belgium, shows that, there's, can be productivity enhancing to link to superstar firms, link to multinationals. They can have sustained productivity gains due to technology spillovers. But the second aspect is that these links are not only valuable, the question is, do they form in the first place, right? If we invest heavily in special economic zones, if we give tax credits to innovating firms, the extent to which these will benefit the economy at large really depends on how well these firms are integrated into the rest of the economy. And if they're not, we're potentially leaving a lot of things on the table. And this is really sort of the double dividend of production networks and how we call it, is to think about these networks and how can we make them function better, how can we facilitate linkages, to have economies be more competitive in international markets. And the second one is thinking about distributional implications, right? When production networks function well, it's not only the port or the large cities or the frontier firms that benefit from economic growth, but sort of market opportunities, knowledge spillovers can reach firms beyond the frontier, can reach remote areas of a country, and that's really important for equal opportunities. So now going to the firm-to-firm data itself and sort of a few kind of examples that I sort of collected along the way of my years of probably 8 years now working with this kind of data. To give you an overview, I think what to me the main strengths of these data are, and I'm repeating some of the points that have already been made, is really threefold. It's they capture firm heterogeneity. It allows us to single out large firms, SMEs, multinationals, high growth firms. It also enables regional subnational analysis, which is really key, and as Keith was saying, it's very often hard to observe. And it has a really broad sector coverage, right? Being a lot of statistics on firms, surveys, we focus on the manufacturing sector. But for example, this data covers the service sector phenomenally well, right? It's a sector that employs half of the world's labor force, and yet we know very little about it and how productivity works in this really important sector. But let me give you like 3 kind of concrete examples. The first is one from the World Bank, from some of my colleagues who've been working with the Revenue Authority in Honduras. And the Revenue Authority there had an export exemptions regime going that gave tax credits to exporters. And it was attracting a lot of criticism because the sort of conventional view was these firms are really detached from the rest of the local economy. And then they went into the firm-to-firm data generated by the VAT system of the country, and they found that actually this was not the case, that these firms that benefited from the regime actually had similar linking patterns to similar firms in similar sectors and of similar sizes. And this kind of finding and this kind of direct, backing up the policy was only possible because the team had beforehand invested in a data infrastructure, has created a lab in the Revenue Authority where researchers from the government, from all various departments, as well as external academics, can access the administrative data and really, use it for these kind of questions. The second one is an example where some of my own work with my co-authors, where we work on looking at the implications of the EU's carbon border adjustment mechanisms on firms in Turkey. And what the firm-to-firm data allows you to do is to go beyond direct importers and exporters, which we know a whole lot about because trade statistics are great. But there are many firms actually that are indirectly linking to export markets because they, for example, export through a wholesaler. And what we find is in the context of the CBAM, that matters for two reasons. One is what we find is, many more firms are affected by the policy than we would otherwise see in trade statistics. And second, the data helps us to how these wholesalers that are kind of at the junction between the domestically operating firms and the export markets might respond to the policy. Relative to manufacturers, they really specialize in doing one specific product well, and then they sell it across markets to the EU, outside the EU, in the Turkish domestic economy. Versus wholesalers, they specialize on a market itself. So they only export or largely export to the EU, but a wide range of products. And now for them, the response to the policy might be very different from a manufacturer, because for them, the decision is really, do I want to specialize in products shifting away from the CBAM and keep sort of focusing on them because I already have a wide portfolio and just adjust this a bit, or do I hone in and go in all in on the CBAM products and become maybe a force of helping firms to comply with the regulation and the standards? And how these wholesalers will respond to the policy will really shape market access for these indirectly linked firms that we're able to observe thanks to the VAT data. The third example is from some work that I've been doing in Kenya with my co-authors, where we use the data for precisely this reason what Keith described, is to map domestic trade flows. And initially, we had a paper looking at shock propagations across regions, finding how concentrated trade flows are in the capital Nairobi, and how we can use other statistics to then account for the shadow economy and how that distorts measurement. But the real impact actually came from something exactly like Keith was describing. It's the fact that we demonstrated that you can use this data to track subnational activity at a very high frequency, and you can see what regions are well connected, which are not, how that changes over time. And that caught the attention of a team in the World Bank working on the lending program with the government of Kenya. And they were looking for exactly means to track domestic market integration. And when they saw you could use firm-to-firm data, they integrated our measure on cross-regional trade as a policy target for an ongoing loan. And it is now tied to a concrete policy, including a law that the Kenyan Parliament passed last year, which is to harmonize subnational business license schedules in the country. And basically every year I get an email to update the indicator, and hopefully in a few years' time we'll see the trajectory a bit more clearly. So this brings me to sort of this cross-country effort that we've been working on. You saw a couple of concrete examples, but we're currently working on an effort similar to what Christina described, where we harmonize firm-to-firm data of more than 15 countries, covering small economies like Honduras, but also larger ones like China, high-income ones like Croatia, and low-income ones like Uganda. In the 9 countries for which we already have results, we cover like 10 million firms and 400 million firm-to-firm relationships. We again also collaborate with revenue authorities, central banks, universities, World Bank colleagues that have access to this data. And what we kind of did, we built on this experience that we've developed over the years working with individual countries to come up with templates and protocols for harmonization, tackling some of these issues that Keith and Rajssa were describing about, how do I identify a business? How do I do this consistently across countries? because many more entities file VAT than are actually businesses. How do we make sure that these are meaningful firms and not someone bidding for tender, right? How do we deal with sector classifications? And we really benefited from experience across a wide range of countries that sort of now has enabled us to build a machinery that makes this cross-country comparison possible. A few small sort of tweaks, insights into some of the results that we're finding. It really shows how central large firms and also how central cities are to production networks. On the large firms, only about 2% of firms in economies are large, but they account for 60% of the business-to-business sales. And then we can also think about who are the counterparts of these firms, right? Most counterparts of large firms are small firms. Only 5% of all transactions in a network or relationships are between large firms themselves. But these 5% of relationships can carry up to half of the aggregate trade in an economy. So they really shape what is going on in national statistics. And we can then also obviously look at how large firms are distinct from small firms, finding similar effects to what Christina described, that large firms tend to have 20 times more buyers and 8 times more suppliers than the smaller firms. And importantly, because we also do subnational analysis, we can see that the ones who are driving cross-regional trade are really the large firms, especially on the output side. Large firms are able to sell to other regions within the same country, versus sourcing is something that firms across the firm size distribution are doing in a more even manner. Similar when we look at the importance of cities, when we look at the number of firms that are located in cities versus how many links are actually coming out of cities and how they act as a hub in the economy, we find that cities carry actually 15 to 20% more weight in the aggregate economy. And it's not just business services, but it's also utilities, distribution, logistics that are driving this role of cities as a hub. So basically, what you can learn from this kind of data is not just about supporting SMEs or supporting specific regions in a country. It's really also about fostering links between them and the rest of the economies, reducing barriers to search frictions, and thinking about ease of compliance with standards and so on and so forth. There's research on all of these topics, which I sadly won't have the time to go into, but I'm going to end exactly on the same note as Keith. We're really just scratching on the surface of what this kind of data can do, and glad to be part of the discussion on where this is going.
Right, so we'll now move to the sort of question session, and it's a hybrid format. How we'll handle this is I'll take a batch of 3 or 4 questions and let the panel answer the ones they want, finishing with Verena online, then we'll take another batch. So in terms of questions from the audience, have we got some? So we've got a lady over there.
Hi, thank you for your presentation. I'm Marina from the Department for Business and Trade. Just want to say that the data is fascinating. I can see so many different uses for it. I like the example that Keith used for the Land Rover example. In times that things change so rapidly, this is really, really good. My question is whether the OECD project mentions that the UK data is not compatible with the current structure of the methodology, but would be possible to run using the bank transaction data. Is this something being considered? And finally, does the data capture transactions of inflows and outflows of cash going abroad, or is it just UK focused? Thank you.
Cool. And I think there was one next up and then one at the back.
Hi. Yeah, Alex Gibbard at Heriot-Watt University. Thanks for the talks. It's really good. I think the CMA report is really interesting for me. So I've got some kind of technical questions maybe we can ask offline. But one thing I wondered if you thought about was, how do you try, or have you attempted to disentangle kind of like capital formation from costs used for production? So obviously the payment flow is kind of capturing stuff which is used as inputs, but also could be investments and things like that. Is there any kind of view on that you've taken?
And there was one at the back.
Hi, Gemma from Department for Business and Trade. How do you handle the safety of this data, sensitivity, and thanks?
Cool. Okay, Christina, do you want to kick off?
Sure. Let me start with last in, first out. So safety of the data. Obviously, anyone that works with firm-level market data should have safety first at heart. If it wasn't just for the OECD, I was 3 years working at the Economic Market Data Transformation team at the ONS. These issues are really, really important, whether you're on the user or data owner side. There's disclosure controls that are applied at all the statistics that are exported. So you need a minimum number of underlying firms or underlying transactions to export any of the statistics that you've seen here. And you also apply on top of that dominance checks. These vary a little bit country by country, but the spirit of these dominance checks is that any sort of top 2 firms or top 1 firm can't make up more than 70% or 80% of the statistic that you see. So we really pay attention to never extract statistics that are going to be circulated in any sort of report or communication like today that reveal any sensitive microdata that can be traced back to the answer of a particular firm. In terms of storage of the data, and I think this is important and it becomes even more important when you try to link across data sources, in general, this data doesn't sit on some sort of C drive. You access it in very, very secure environments that are very controlled. It varies from country to country, and I'm sure Keith will talk about how the arrangement works for the UK. For the OECD, for some countries, there's secure remote access. Estonia, for example, has an extremely sort of impressive, technologically advanced system with a sort of e-citizenship program where they first censor who gets access to this data, for what purpose, quite similar to the SRS and the ONS, and then you access the data remotely in a secure environment with your own details. For other countries, we never get to see the data because legal restrictions mean that you can't, as part of the OECD or another organization, access, let's say, Portuguese VAT, but we partner up with institutions or researchers from the country, like the Bank of Portugal, since I mentioned Portugal. They have access to the data, and we write code that once someone inputs the variable names and the settings, like how many years the data set it for, really, really sort of one-on-one, what do the data look like? The code will run in their environment, sort of where the data lives, and they will have a chance, of course. It will also apply disclosure control, and they will also have a chance to review the data, apply their own sort of secondary suppression or different rules if they want to be more strict. In terms of the question from DBT, thank you, Verena. Yes, a lot of these statistics. So first of all, we haven't done research on comparing how production network descriptives that come from sources that are slightly different, so VAT versus transaction data compare. There are some amazing researchers at the Institute of Economic Thinking in Oxford that actually have published a paper where they look into that, and they look into the private data sources that I mentioned from the US, as well as VAT sources. I think they use Hungary and Ecuador and a few others. And they talk about transaction data as well. So there is research happening in the space to see, can we understand the structure of production networks even if we never get invoice level VAT in the UK? I think the answer is yes, but I will refer you to the INET research. And I will say that on a practical level, we could run this code that looks into the structure of production networks without linking it into anything else, to the extent that the sort of technical constraints of VocalLink allow it for the UK as well. Does the data capture transactions abroad? not yet, but I think at least within, what I'm about to say is a long-term thing. It's not going to happen as part of LIFT anytime soon. But as a result of VAT modernization, at least within the single market is moving for tax purposes, not really for economic microdata purposes, but it's a nice perk for us, into a single VAT for a firm across all EU countries, which means it will be easier to look at VAT flows cross countries through a project where you can work with data across the different countries. In terms of capital, for some countries, and I think Belgium is one of them, you can distinguish, I think, investment from other types of transactions.
Cool. Keith?
Yeah, sure. On international payment in the data set I described for the UK, no, it is sort of strictly payments between UK bank accounts because international payments would have gone through another system called SWIFT, which got very famous during the Russian war because there's a lot of sanctions around that system. No, the short answer is no, but there's a more nuanced answer is, we could look at accounts or businesses that sort of belong to a sort of foreign sort of, parent company. So we could look at sort of UK subsidiaries and maybe sort of come to some, I guess ultimately you're interested in international trade, yeah? So I'm saying like we could potentially look at sort of, subsidiaries and do something there. But no, like, I mean, it would be really nice if there's a neat data set on that, wouldn't it? Capital formation versus expenditure. I mean, I'll let Rajssa to come in on what they do. But in our current format of the data that we have, like there's no way of distinguishing it yet. But potentially, with more data development, we could see how far we go. I'm looking at sort of Joseph and the team up there who is actually doing the work. Because there's abundance of information. Well, not abundance, but there's some extra information in the payment system that we haven't used yet, around reference text for the transactions. For permissions reasons and agreement reasons, we haven't sort of looked at that yet. But potentially, there's something that we could look at there. How promising it is, I'm not sure. But it is something on our mind that it's one of the user feedback that we keep getting is it would be nice to be able to separate sort of those two things, and for obvious reasons. And yes, the safety of the data. So. From my point of view for the project, the data that I'm talking about, it is a collaboration and a partnership with Vockeling and Pay.uk, who are the sort of guardian of the data, and obviously they take it super seriously because you can imagine like transaction account level data is extremely sensitive. So it's through a collaboration with their data scientist and our data scientist that we sort of jointly sort of produce this data, and sort of what is taken out of them is only sort of aggregated versions of the data that have been disclosure controlled. So, ONS actually do not receive any sort of disclosive data. Although I think there's a wider point here about, what can we do, to sort of give wider access to the research community and the policy community to the sort of raw data. I think it's a really big question because we're working across private sector, public sector, organizational boundaries, data sharing. I imagine, just to cover off any potential questions, you might be thinking, how do we do the sort of linking to like industries and regions, right? Right now we only do it with sort of linking, companies' name, sort of account names to whatever we can scrape on sort of company's house, which obviously there is a lot of questions rightly about the approach. But people have asked us, why don't you link it to IDBR? Why don't you link it to whatever other business register that you have? Or I think the short answer is we're trying to work across like organizational and public sort of private sort of boundaries, and that sort of data sharing are they're not insurmountable, but they are like you've got like big teams of lawyers on both sides, right? Arguing with each other about like how to go about these things, but it's something that we're aware of, and hopefully one day we get to a world where we can do that. But hard to promise anything.
Cool, Rajssa.
So on Alex's question, I think Keith has partially already answered to that, but no, unfortunately, we can't do that. That's a very interesting angle that potentially we might just explore in another research work. But I think in order to do that, the data set that we are using in the supply chain work is the one that's already aggregated at industry level. So that would be even more difficult to do that with that data. With the firm level data set that lies behind the aggregated one, it might be something that potentially in the future, it's explorable. But yeah, unfortunately, we don't do that. And just a little bit of anecdote. Well, it's not even an anecdote on the security. I think I started working with UK microdata around 4 years ago, 3-4 years ago, and I thought that the ONS had some very, very good security rules and guidelines and approach, and that was very, very strict. I reevaluated how strict they are normally with UK firm level data when I saw what my colleagues had to do to actually access the firm level data. So there's a lot of layers of checks and guidelines and very strict rules to access that.
Cool. And Verena?
Yeah, I can potentially comment on this sort of data security aspect as well, because especially if you're working across countries, and everybody has a different standard. I have to say though, they're broadly similar across countries on what's feasible. But what we in the project do is we build these standards into how we compute aggregated statistics from the get-go. So, for example, if you disaggregate firms by sector and size or by sub-region and sector, the data can get sparse, right? And what we then apply sort of in the code from the get-go is masking strategy that, if the cell contains too few firms, we will automatically blank a certain row in the aggregate data that, we ask the counterparts, very much in the case of Christina, on the other side, that sit in a central bank, that sit in a university data room, or that sit in a revenue authority. When sort of before they take out the data, they will already have the data set that complies with the standards that we impose, which again are sort of a common denominator across countries, basically applying the most strict rule that we encountered to all countries. So you can build this really nicely in from the get-go and still do cross-country comparison. But it's extremely important, and this is part of the bread and butter and day-to-day work with revenue authorities across the globe, this kind of conversation.
Cool. Are there any more questions?
We've got one online.
Oh, good. Okay, so on firm-to-firm transaction data, is this available at a company level for government analysts, e.g. to see domestic supply chain for sectors not covered by SIC codes? Don't see any other hands up. There's one there, and there's one there, but I'll also chuck one in whilst they're going. As Keith kind of made it clear, these data sets are big even by data science standards. So there's an interesting question of how do we get the tools to even actually understand it? Because obviously if you want to open this up to wider usage, you need to find a way of helping mere mortals navigate, 1 billion transactions, 180 million entities and several trillion pounds of expenditure. Okay, another question there.
Thank you very much for those presentations. I'm going to push the boundary even more, because obviously what's been done to date, described by the panelists or presenters, is really impressive. So on the VAT side, can you distinguish from standard rated, zero exempt, etc., by product? Because that's really useful, because obviously there's a lot of products where the VAT rate is 0 or they're exempt, and that's really informative. And then likewise, on the firm level transaction data, industry by industry, can you establish what are the products that they are paying for? Because that would add a significant dimension linked to product by product analysis as well. Thank you.
Yeah.
Cool. There's one.
Thank you for those presentations. Sorry to single you out, Keith, but so I'm Brad from the Office for Statistics Regulation, and I used to be part of the ONS Data Linkage Hub. And so you anticipated my first two questions, which were, why aren't you linking this to the IDBR or Companies House? I just wondered what work the ONS is doing to understand the characteristics of businesses that aren't being picked up in the business-to-business transaction data, and why, and yeah, sort of what work's going on in that space to just get a better understanding and perhaps improve the coverage, even though it was pretty impressive as you pointed out.
Cool. Okay. We'll start with Christina again.
I've forgotten the online question, I have to say, but I think it was for UK specific. Yeah. Okay. Okay. So Sanjiv and VAT by product, some countries that we work with do have actually product information. I think Costa Rica, after 2021 onwards, has product information. For most datasets, you wouldn't have that. There are loads of interesting things that you can do. For example, imagine, and now I'm going into the area of the speculative. This is not something that we've done, but this is something that I would do if I was more interested in sort of the product dimension. For countries that you can bring in trade data at the firm level, these are extremely rich in terms of product information. So now you have the SIC code, you have transactions firm to firm, and the SIC codes of these transactions. So you kind of start understanding a little bit what this firm is about. And you also, at least for the firms that trade, have some sort of understanding of the products that they're trading as well. For countries that you have production surveys, actually the UK is one of these countries. We have the APS, right, where we ask all companies that participate in the survey, what is it that they're using for sort of their intermediate consumption. You have a little bit of product information there that you can combine with the transactions data. So yes, it appears, you have it for some data sets. There's a lot that you can do even if it's not in the VAT data per se. Big data, even by data science standards. I mean, there's two things that you can do here, and we're not the first ones to have this problem. Lead data sets are like 1 terabyte or something when you're talking about income tax records or DWP records that are 3 million firms but 66 million people in the UK, each of whom might have some sort of record for some sort of benefit or some sort of thing that they own or they receive, and then more than one jobs potentially. So we need to become better coders. This is some people go straight into we need more space and we need more computing power. This is also important, but we also need to become better coders. This is not something that, at least when I was in undergrad and master's, it was sort of very important. I think people that are actually graduating today are much, much better at these things. I go sometimes to career events, and someone 10 years younger is like, so I can code in SQL and Python and work with this data set and that one. Do you think that is enough? And I'm sitting there thinking, I knew none of these things when I graduated, so I think you're good. And the second one is focus on that matters. And I guess another way that I could summarize that is, apart from better coders, we also need to become better storytellers. And we had I'm sure Verena has had this conversation as well, especially when you work cross-country. It is very easy to get caught up into the things that are different between the different data sets. Oh, this one includes more small firms, the transaction threshold is a bit larger, is a bit smaller. The questions that you're trying to ask are bigger than that, right? They're a bit about what's driving growth, what's driving growth of X type of firms, what structure of the economy seems to be delivering better outcomes in terms of resilience. And these marginal differences of whether you're going to work with sort of a network that X big or smaller or these kinds of relationships or X, as you start curating the data, focusing on what matters would also really, really help with the overwhelm of information that's available in these data sources.
Keith?
Sure. So the first question on is the data I spoke about available, at the firm level to government analysts. I kind of sort of answered it already. Well, the short answer is no. Because ONS don't get the firm level data ourselves. All the work sort of takes place through a collaborative arrangement within the payment system infrastructure provider. Although, as in, you've seen, we've collaborated with CMA colleagues on this, so there are ways to facilitate sort of things to happen. Do get in touch if you want to discuss more. We can, we'll find ways to make things happen. How to navigate the size of the data? My team is up there. It's a constant headache for them, for the last, 2-3 years. It's like, even for the payment system sort of provider themselves, right? The infrastructure there, I think it's fair to say, is pretty sort of clunky. I think as you find in all these sort of big, systems, like big companies, right? The system is fairly legacy-ish, and so I think it's a real challenge. But I think just through improvements in data science and sort of the production processes that we put into place, I think over time when we first started working with these data, even for us to aggregate it to these sort of industry level, took us a few days. And right now it's a few hours or maybe under that. Yes, and we're constantly sort of pushing our partners in Mechelli to give us more memory, improve their system. But it's a real challenge. It is a real challenge. Actually, for a lot of these companies, we've noticed even for companies that you think are very modern and have whoever have got lots of data, I think they always sort of have this sort of issue. What are the products that, the products question. No, in the payments data, well, unfortunately, no. We only see the total amount being paid. But like I said, we have not explored the possibility of using payment reference to do something, although my hopes there is not super high. But maybe there's something we could do in terms of, linking to aggregate sort of, information from elsewhere, from ONS on what industries are buying, in input-output tables, supply use tables. Although obviously there's a bit of a time lag between the two, and I'm sure there's nothing some magic assumptions can't do. So we'll see. And then final question: what work to understand the characteristics of firm not classified? I said we classified about what we think about 3.5 million sort of organizations. That leaves around 2 million or so, that is not classified. But our understanding is we have classified. If you look at the business population, there is a massive tail end of very small and probably not very productive firms that that do not contribute, a big deal to the overall economy. And I think that's what we're looking at. We're pretty confident that we have, classified the big chunk of the economy. So the rest, I think there's always a limit to how much we can push it. We keep trying, but I think we have in our first publication 2 years ago, it was we classify 110 firms. Sorry, 110,000 firms. Yeah, 110 would be terrible. 110,000 firms. And then a year ago is 3 million, and then this year is 3.5 million. So we're hitting that sort of diminishing return, but we do think that we have covered the absolute majority of organizations that matter. But it's a good suggestion. We haven't really done too much on the characteristics of firms that we have classified and how that relate to the overall business population. But yeah, we can definitely take that on board and go away and do some analysis.
Rajssa?
Just on very briefly on the size of this data set, it's obviously I agree with them. It's a real challenge. To some extent we can try and become more efficient. We can increase space, but I think and Keith has talked about this a little bit. A big a big chunk of the thing is like a sort of sunk cost, like an investment at the beginning, and then like things like, as more and more people work with this data, both like from like the statistical office and like researchers, and more less there will be this issue in like dealing with like the big data sets. Because at least like in terms of like the structure of the data set and like how much like understanding we have of them, it will definitely improve over time.
Cool. And Verena?
Yeah, thanks so much. Quickly on the question of standard rated, zero and exempt, yeah, you can see this in the data very clearly, or what kind of sales are in these respective brackets. The one category that's tricky is exempt. So exempt is often in a lot of jurisdictions, it's voluntarily like for the firms to declare. So this is sometimes something that you miss out in VAT data as exempt kind of sales. So this is definitely a gap that you need to then think about how important that is for the economy, or what kind of firms are voluntarily declaring it. This directly links actually to the product codes question. There are kind of two types of VAT systems. I tend to call them sort of the standard older model, which used to be like more like annexes where firms document who they trade with, versus kind of the really kind of modern version, which is invoices transmitted in real time by businesses to revenue authorities. And these kind of data now, like, it actually has been a huge revolution I think across the globe, like in the last 5-6 years. More and more countries implemented the system, and these kind of systems track quantities, prices, product codes. And there's now a really interesting paper in Chile, which actually shows that the same company selling to different buyers charge for the same product very, very starkly different prices. And understanding, for example, why that's the case, also from Rajssa's point of view, is probably really interesting, a market power question. And the other one is, thinking about large firms trading with each other, right? I said these large-to-large linkages account for, up to 50% of national trade. The question is that because these large firms are having massive transactions, or is this because these large firms are trading multiple products with each other in one relationship, right? And these kind of very different implications for how we think about them and resilience in the economy. So I think the new generation of data will really open up this kind of box. I think in terms of the bottlenecks on these data, I think the challenge is real, and you have to be really like smart in terms of how you set up the code and all these kinds of things. I was fortunate, I think, to be starting my PhD with this kind of data, so it has always been at the forefront. I have to say it's become much easier with AI and thinking about how to write smarter and better code. I agree with Rajssa on the upfront costs. The real big challenge is processing the data for the first time, cleaning it for the first time, having a comprehensive, clean extraction. I think the leading example of where this process that Rajssa described has actually been taking place is in Turkey, where the Ministry of Finance hosts an incredible data center where they merge all sorts of data sources, and it's repeatedly used by researchers, people from all across the world travel to Turkey to do research on this data. And they have really good, protocols and what you can do when you take out this data, how to, become a user of this data. And you walk in and basically you have the whole machinery up and running as a researcher, and you don't even have to think about all these tedious questions that all of us had to deal with, like working with some sort of data the first time around. So it becomes easy over time.
Okay, thank you very much. I think we're almost to time, so I'll draw it to close there. So if we could just thank our panel again for a great session.